Top tax deductions for small business. Part 1. Let's take a look at the most common business deductions and the rules for taking advantage of them. Asterisk vehicles. There are very specific rules and limits for deducting vehicle expenses covered later. Asterisk equipment and furniture. The deduction of costs of acquiring assets such as equipment and furniture is also discussed later. Asterisk inventory costs are deducted differently from other costs. Asterisk home office. A home office can generate such significant tax deductions that the subject is discussed in detail later. Asterisk retirement account deposits. Tax contributions to pension plans are also so important that they are the subject of their own video. Asterisk hiring help. Many, if not most, small businesses will need to bring in workers at some point. These employees will either be employees or independent contractors, each governed by different tax rules. Asterisk rent. Rent is any expense related to the use of real estate or any other type of property that is not owned by your business, but is used in the operation of your business. This may also be called a rental payment. This type of expense is 100% deductible if it is 100% related to professional use. Alternatively, if the rental expense is partly for personal use, such as a car you drive for pleasure as well as for work, you must reduce the personal use percentage deduction. Asterisk costs of going into business. Which tax deductions are available for the pre-opening expenses incurred in starting a new business? The expenses associated with beginning a venture are commonly known as startup costs. There are 3 options for startup tax regulations, along with an additional bonus rule to consider. To determine the maximum tax benefit, compute the numbers by testing each of the described rules and identify the one that yields the highest result. The majority of individuals tend to prefer maximizing their deductions right away and would typically choose the initial rule. Nevertheless, there are instances where this approach may not yield the optimal tax advantage in the future. For instance, if you anticipate a gradual start followed by increased profitability in subsequent years. The second rule seems to be the preferable option because the majority of individuals tend to ignore the third rule. Rule 1. In the initial year of your business, you have the opportunity to subtract a maximum of $5,000 from your startup expenses. Any amount exceeding $5,000 must be deducted over a period of 15 years through the process of amortization. If your startup expenses surpass $50,000 for the year, certain limitations apply to this deduction. In the event that your initial year was lacking in profitability and your second year appears to be filled with uncertainty, it may be more advantageous for you to opt for the second rule. Rule 2. In tax terminology, it is possible to deduct your startup costs proportionally over a span of 15 years, a process commonly referred to as amortization. Rule 3. Rather than deducting any startup costs, you have the opportunity to recover these expenses by either selling the business or ceasing operations. Deductions for business organizational expenses can result in additional bonuses. Small business owners can benefit from an extra deduction of up to $5,000, specifically designated for organizational expenses. The deduction mentioned here is specifically relevant to business entities, such as corporations, partnerships, and limited liability companies, excluding sole proprietors. In order to be eligible for the deduction, the sum of your startup expenses must not surpass $50,000. Furthermore, this deduction is separate from the deduction for startup expenses that was previously mentioned.